Today I would like to analyze Alibaba. It's one of the more interesting Chinese stock. So Alibaba makes 70% from their Chinese e-commerce and around 9% from their cloud business. And then they have the international e-commerce with around 7%. So they are international and they have a strong market in China as well. And if we take a look at the stock price, we can see in 1 year we are up around 16%. And in October, we had the very high around 50% increase. So now we are down from this higher point around 26%. And if we take a look at the 5-year charts, we are still down 62%. So it could mean the company is still undervalued if we compare it with the 5-year chart. And we have to take a look at the financials to find out if this company is a buyer right now. The first thing we can recognize about Alibaba is a huge market cap of 1.55 trillion Hong Kong dollars, which equals around 201 billion US dollar. Compared to other bigger companies like Amazon, it's still a small company actually. And we can also see here we have 1.96% dividend, which is not bad as a technology company. And the first thing we are looking for is revenue growth in the last 5 years. So we can see here we have a very strong revenue growth around 2021, 43%. Then again, 26% increase. Then we have the small decline around 4% in 2023. And then we have the increase around 3% in 2024. So overall, it's looking good. I think it's a good revenue growth in the last 5 years, and it's a check here. The next thing we are looking for is free cash flow growth in the last 5 years. This is a very important number because the free cash flow can be used to pay back the debt, to buy back their own shares, or to pay the dividends. So it's a very important number and we would like to see that grow. We can see here, this is the number for 2021, 151 billion Hong Kong dollar. So then we see here we have a good growth around 42% in 2021. Then we have a decline around 49%, which is not great. Then we have an increase again, and then we have a small decline again. But overall, we have a growth in the last 5 years. It's not incredible, but it's still a check here for me. The next thing we are looking for is free cash flow yield over 4%. This is also very important because this tells us about the valuation of this company. So if the free cash flow yield is under 4%, it could mean the company is overvalued right now. And what we're going to do now is we're going to take the free cash flow in 2024, around 163 billion Hong Kong dollar. Then we're going to use this number here and divide it with the market cap. And then we're going to get the free cash flow yield. So the free cash flow yield is around 0.10. So around 10%, which is a really good number actually. They have a lot of free cash flow to buy back their own shares and to invest in their own business as well. So it's a check here. And I think from the free cash flow yield, this company looks undervalued. So the next thing we are looking for is debt to free cash flow ratio under 5. This means a company can pay back the debt with the free cash flow in under 5 years. A very important number as well, because if a company has too much debt, is risk to go bankrupt, and we don't want to see that. So what we're going to do now is we're going to take a look at the short-term debt. It's around 37. Then we're going to take a look at the long-term debt, around 184. And then we're going to divide it with the free cash flow, 163. And then we're going to get the debt to free cash flow ratio. So it's around 1.35, which is a great number actually. So in little bit over 1 year, they can pay back the debt with the free cash flow. It's a great number and it's a check here. The next thing we can do, we can also take a look at the cash on hand. We can see here they have around 651 billion Hong Kong dollar cash on hand. they can already repay the debt. And even compared with the market cap, this is like a little bit under half of the market cap. So they have a huge amount of money that they can use to buy back their own shares, to pay dividend, or to invest in the business. So the next thing we are looking for is shares outstanding decrease in the last 5 years. And we can see here the shares outstanding did decrease of Alibaba around 0.6% in 2021, then over 3% in 2022, and then again over 3% in 2023, and then close to 7% in 2024, which is an incredible number. This means they buy back a lot of shares. We can see it here as well. Repurchase of common and preferred stocks. So they use a lot of money to buy back their own shares. And we like to see that, especially if the company is undervalued. And this can definitely help the stock price to increase. So it's a check here, and we really like to see that. I would like to give my conclusion about this company. So let's start with a positive. They have a strong revenue growth in the last 5 years. They have a free cash flow growth in the last 5 years as well. Even though it's not so incredible right now, they have a high free cash flow yield over 10%, which is really great. And I think it shows that this company is undervalued right now. They have a great balance sheet as well, which means a lot of cash on hand that they can use to buy back their own shares or to pay the dividend. And they have a low amount of debt as well, which they can easily pay back with their free cash flow. Then the next thing would be stock buybacks. They buy back a lot of shares many years already. So this can help the stock price to increase, which is really great. The more negative things would be competition, even though maybe they are the dominant player and the competition is not strong right now, but it could be something to consider as well. And of course, they are the Chinese company. They have some political risk that we also need to consider. But overall, I think it's look undervalued. It's look like it has a lot of potential in the next year to grow. And I think it could be a buy right now.